All right, this is part two on insurance, and we left off yesterday or in the previous video with renter's insurance, and now we're diving into life insurance. Now, when we get into life insurance, again, as I described in the first video, for the most part, most people probably want to stay away from whole life, cash value, universal, and variable life insurance policies. Those are all cash value life insurance policies, and they're often sold more as investments and things of that nature. So now we actually talk about what life insurance is used for. And what life insurance is it's a policy that once you pass away, there's an amount in the policy that'll be paid to a beneficiary or loved one to prevent a significant financial burden. So if my wife and I, if I were to pass away, the income and the burden that's created from my passing, that life insurance policy is used to supplement the income and the other non-tangible benefits, or maybe sort of fringe benefits that I bring to the table as a spouse. So that's what that policy is used for. Now, if when you die the beneficiary doesn't have a financial burden because of your debt, I would ask, why would you have a life insurance or anything more than to bury you? And I bring that up because I had a student in one class who was military. I think he was in the Air National Guard. And he had about a $300,000 term life insurance policy that he thought, fairly cheap through USAA. And we were discussing in class, I asked, well, do you have any debt? And he said, no, I don't have any student loans. Military pays for most of my schooling. So nobody really I don't have any financial debt or anything else. And I asked, well, who are the beneficiaries on the policy? And he said his parents were. So as we were talking, and I realized there was no financial burden there that his parents would really be taking on, other than probably the cost to, unfortunately bury him and just get his estate all cleaned up, which is the matter of maybe hiring an attorney for a few hours to make sure all is complete. I said, why do you have a $300,000 term life insurance policy? And he looked at me and he said, well, because it's cheap. That might be, but if you think about it in terms of, will this actually happen? And paying out, I think it was $15 a month, he said, is what he was paying out for, and it was a 20-year term. I said, okay, do you understand then you're paying for something that has a very low likelihood of happening, number one. Number two, I asked, do your parents need the money? And he said, no, they're actually fairly successful and probably don't need the money. So really in that situation, all that's happening is money is being paid out to his parents, or would be, because they were the beneficiaries on the policy. They're not going to have any burden. So in essence, the prevailing wisdom would be, then all you're doing is cutting a $15 check every month for a life insurance policy that's really not needed. So it's something to think about and something to consider. Now, one of the other notes and bullet points I have up here is you need to make sure you know if you're the beneficiary on any policy that exists out there. I think it's very important that we know that, because in rare occasion what can happen is you might have, or somebody, a loved one, spouse, somebody else, might have a life insurance policy where you're the beneficiary. And if they pass away and you in fact have a financial burden, and this person, the beneficiary, doesn't know the policy exists, it might take a significantly long time to get that policy paid. And actually had an article a few years ago about a wife whose husband had just passed away, and he had handled all the money issues, everything else, and she ended up almost filing for bankruptcy until it was found out at the last minute that in fact her husband had a $1 million life insurance policy on him. But she went through tons of turmoil, infighting with family and other things, before it was ever figured out, or she ever figured out that she had or was the beneficiary on her husband's policy. So again, it's just important that, and when you take out a life insurance policy, that you inform the beneficiary on that they are in fact the beneficiary on that policy. Sometimes, especially when it maybe isn't spouses, that can happen, and it's important for the other person to know that. Now, typically, in a life insurance policy, we take those on, and you want to get one whenever you have a significant change in life happening. In other words, maybe changing jobs where you're making significantly more income, or if you're starting to have children, or if one spouse is maybe no longer going to work, but they're going to stay home with said children. What happens then in those situations is you've altered your lifestyle a little bit, and that's usually when you have to take into account the financial burden of the other party or your family in those situations. So it's very important. Typically, life insurance policies you're allowed to renew or update, get new ones when you have one of those change of lifestyle changes that happens. Again, having children, things like that. So that's what we're talking about with life insurance. Typically, you get those policies for 1, income replacement, 2, financial expense needs, burying a person, readjustment period. If one spouse dies and there are children involved, typically the other one will have to start working. Well, then all of a sudden you have child care costs that have to start being paid, daycare and things like that, and that would be called a readjustment. Other things that you can put in there is college expenses and debt repayment. So I'm going to use my wife and I as an example. We have, I think, about a $600,000 or $700,000 policy on my wife, and the purpose of that is if she were to pass away, I'll get the money, and my kids and I think, are the beneficiaries on that, and that money is to be used for me to help raise the kids and do those types of things and make ends meet. And also, there's some money that we added on to that for possible college expenses. And a portion of that will pay off our mortgage entirely, and we'll be left with no debt. So, again, things to consider. And this is usually what a life insurance policy is used to pay. All right, now we have 2 types. We have the cash value, also known sometimes as whole life or universal life insurance. Unfortunately, insurance agents often like to push this type of policy because their commissions on it are huge. If you look at a similar policy that pays out, let's say, $500,000, $500,000 for a term policy versus a whole life policy, the whole life policy premiums usually will be 10 times more than the term life policies. In the whole life policies, the insurance agent will pay or get paid as much as 140% commission on the first year's premiums. So that's huge, and it's a huge benefit to them to sell those types of policies. Again, unfortunately, those aren't policies that are necessarily very good for the client. In fact, most of the time those policies are sold when they're not needed. Now, again, there are certain circumstances where a whole life policy might be beneficial, and we usually see that when we're talking about farms, agricultural properties, small businesses, things like that. So the other type of insurance is the term life insurance, and that's a policy that only pays out to an extended term. When you have children, usually you'll want to get a new policy that maybe has a little more of a payout, and what we try to figure in that is how much will be paid to supplement all the income. But then that's only for, say, 20 years. After 20 years, you won't receive any of the money if that term expires, and you will have just paid all that money towards the insurance agent. Okay, but again, it can be as much as 10 times less of a monthly premium versus whole life. So that's the benefit to that. Most financial professionals advise using term insurance because the premiums are much less. And when you're getting insurance, that's what you want to be getting it for, is insurance. Again, whole life policies are often sold as investments. And what most financial professionals will argue is, well, if what you want is an investment, then go invest the money. Don't get an insurance policy to do that. One of the downsides of the term insurance is once the policy expires, you do receive nothing. Whole life will pay you back in some way, shape, or form. Again, most financial professionals, personal financial professionals, would advise against whole life. One, because you pay a large portion of the total value of the policy compared to term insurance. And how they pay that out, it's a financial model we use to figure out how much is initially paid, and even if you want to close out the policy, you'll get your money back or some of it. But it's a little like a mortgage, where in a mortgage you pay based on an amortization table. So for example, the beginning of paying a mortgage, you pay very little in actual principal, and most of that payment is actually going to pay interest. Similarly, with cash value or whole life insurance, the same is true, where your first year or two's payments into that you're not going to get that money back because you're not filling up sort of the principal bucket in that whole life insurance policy. Again, often sold as an investment. The problem with that, though, is that it's usually a very low rate of return compared to a different type of investment whose purpose is actually to be an investment. And what we usually say is, if you're purchasing the policy for insurance, then what you want is insurance, not an investment. All right, another thing we're going to quickly touch on is disability insurance, or long-term disability insurance. And this is, I always like to say, that's Aflac. If you're hurt and miss work, this will pay you for an extended period of time when you're unable to work. Now, one of the things you could do in a situation like that is to build an emergency fund and rely on that. Typically, though, similar to term insurance, you're not going to pay a ton of money for that policy. And again, if you become injured or miss work for extended periods of time, then this would be a policy that will pay in that. And again, most financial professionals would suggest this is something you want to look at, because this can cause financial catastrophe in the household. So something to consider. Couple other tips on life insurance. If you're single with no debt, the most life insurance you'll probably need is for funeral expenses. Life insurance should not be used to make your loved ones rich when you pass away. In other words, if you make $50,000 a year and your spouse makes $30,000 a year, you probably don't need to get a $5 million policy that pays out at the end or when somebody passes away. Okay, the purpose is to get enough in order that the other person is living the same lifestyle that they were before, and then that isn't another adjustment on top of losing a spouse. So you do want to consider all the beneficiaries' needs when determining how much life insurance to purchase. I would advise going online and typing in term life insurance calculator, and that would give you, that's the financial needs replacement method of figuring out how much insurance to get. And it will have a bunch of different boxes that you enter in what you actually need. Now, back in the day, we used to say, instead of doing that, and maybe kind of a general rule of thumb, is multiplying the annual earnings of the household times 7, and that will give you, it's a multiple of earnings, or the multiple method of figuring out how much you need. I would recommend using a financial calculator or a term life insurance calculator to figure out what needs to be replaced. I would say it probably needs to be somewhere between 5 and 10 times what the annual income is of the household or of the one of the loved ones. So, for example, my wife makes way more than I do, and she has, again, probably a $800,000 policy. Actually, it's $800,000 policy if she passes away, that I would get using the multiple of earnings that is between 5 and 10 times her annual earnings. So that, again, is typically how much you need. Again, I would use a life insurance calculator to figure out what your financial needs are. Again, there's two methods of figuring out how much you need. There's the multiple method, which is just multiplying somewhere between 5 and 10 times what your annual earnings are, or use a calculator. Now, there's many different options out there to consider when looking at insurance, and I highly suggest shopping around. Many years ago, you would find a huge disparity between term life insurance policies. That's shrank. So now, if you look at the different ones, it's going to be a little different month to month for the premiums, but I wouldn't say it was anywhere near what it was 30 or 40 years ago. So do your research before purchasing insurance. And again, I would recommend using a life insurance calculator to figure out your needs. Couple things about student loans and life insurance. If you have student loans with a private lender or bank such as First Bank and Trust or Home Federal Bank, and someone else is a cosigner or guarantor on that loan, then you would want a term policy to cover that debt. If it is, though, a FAFSA, federally subsidized loan, and you pass away, that debt actually gets canceled. So for your those types of student loans, federally subsidized ones, you don't need a term life insurance policy to repay those. Those close out when you die, so you don't have to worry about repaying those. But again, if you have a private loan through a bank, and somebody else is the cosigner or guarantor on that, then you'd want a term policy to cover that so that debt gets paid back. Now we get into auto insurance. And used to love asking this question. Things have changed a little bit, but I used to ask, in the state of South Dakota, is it illegal to drive without insurance? And I know in the classroom, all the students would look at me like, okay, this sounds like a trick question, but at the same time, it's got to be, car insurance has to be mandatory. And the truth was, a number of years ago when I would teach this, the answer was no. In fact, you didn't need car insurance in the state of South Dakota. What you needed instead was what's called proof of financial responsibility. And that is different than proof of insurance. Okay, proof of financial responsibility simply suggests that you either need to have insurance or you need to have a deposit set up with the state of South Dakota of, I believe it was either $25,000 or $50,000 in the form of either certificate of deposit or surety bond. And if you had that, you would in fact not need car insurance in the state of South Dakota. Now, this has changed. I'm not sure when it changed, a while back, but now I believe the state of South Dakota is requiring insurance. And some other literature came out on this, but I know it has changed. So anymore, yes, you do in fact need insurance as a form of financial responsibility. Now, auto insurance actually combines four types of insurance. There's one component that's liability insurance, one part that's medical payments in the case you injure another party. There's uninsured insurance in case somebody hits you or causes an accident that does not have insurance. And then there's insurance for damage to your vehicle. So, first thing we'll talk about is collision insurance. And the part of the auto insurance policy of collision insurance protects the insured against collision with another vehicle, object, or if you were in a rollover. Then we have comprehensive insurance, which protects against damages other than collision, rollover, such as fire, theft, vandalism, and hail. Couple notes on auto insurance policies. One, family auto insurance policy sometimes is recommended because the premiums are less than insuring each individual in the family as a separate policy. And it covers those that are authorized to drive the vehicle by the owner. And it's a very common policy, again, to get those premiums down. Now, it used to be financial professionals would advise that spouses actually put the vehicles in one name to reduce the legal liability in the event of a lawsuit. That has become less so here in the last number of years, where it almost really doesn't matter anymore, and it probably is a little bit of a better deal to get a family auto policy. You'll pay less again in premiums. And when you had separate ownership in those vehicles, it didn't necessarily reduce the legal liability. So some other types of insurance you can look at when your in your auto insurance policy is towing insurance and rental insurance that you can combine into those family auto policies. Now, towing insurance is extremely cheap. This is one, I'll just give you my personal opinion, that I believe you want to get towing insurance on that. Towing a vehicle can often be very expensive, and towing insurance is extremely cheap. I think I pay about $10 a year to cover all the vehicles in my household, whereas if you're going to actually have to pay for a tow, it's always at the most inopportune time, and it's always away from your house, I always think. And I remember a number of years ago I had to have one of my vehicles towed, and it was something like $380 for the bill. So much easier to just have the insurance company take care of that. All right. Now, when you receive a quote on auto insurance, this is typically what it looks like. Not showing the premium, but a quote on what you're covered for. And it has a number / number / another number. And what this means is, and it talks about coverages, in the event of an accident and you injure somebody or there's another person in the accident, this $100,000 would be the amount or limit per person or bodily injury limit. So if you hit a vehicle or hit another vehicle and there were 3 people in that vehicle that were injured, okay, the insurance policy would cover a maximum of $100,000 per person in the vehicle. Now, the maximum this policy will pay out is $300,000 per accident total. Okay, so if 5 people were in a vehicle that you hit and they all had injuries, individually, this would be $100,000 would be the limit per person. This would be the total limit per the vehicle. So $300,000 on this would be the maximum the insurance company is going to pay out. And then this final one here is the payout per accident property damage liability limit total. So to pay for the vehicles that you hit, again, this is how much it would cover. I believe the recommended amount anymore is 100, 300, 100 for total liability limits. And bodily injury limits is typically what's recommended. Now, if somebody always gets, I always get a question in the normal class about, well, shouldn't that be higher? And don't we want more insurance, not less? And that's true. If there wasn't an offset, which is paying the premium every month. You do probably want that at a certain level, but I wouldn't get too wrapped around the axle. You pay for what you get. And unfortunately, in insurance, when you're working with an insurance agent, they would tell you get as high as humanly possible. There are limits based on states that will tell you how much is required, and most insurance agents will make sure they tell you that that's the bottom limit, so you can't get less than that. Now, we'll talk very briefly about health insurance, and the reason is because it seems like every day this is changing, and with the new Affordable Care Act, this is constantly changing, and the legalities that put this into place are always changing. So I'm not going to cover too much in here, but I would recommend that you go online to find a health insurance calculator. And actually, a lot of companies that are selling health insurance anymore will do their own calculation and recommend what type of policy is appropriate for you. There's HMOs, PPOs, and a host of other types of policies, managed care policies that are all very different. And that's not something I can explain in a personal finance class. We could take an entire semester just to explain health insurance. What you need to know is, again, try to find a secondary source when you're needing to get health insurance to figure out what type of insurance is best for you. If in the event you're not married, you're younger, your parents are relatively healthy, and don't have a lot of illness in your family, you may want more of a high deductible type of insurance or a health savings account in that event, where unless you really just want the insurance for catastrophes or extreme loss, but for the most part, maybe you're not going to the doctor very much, so you don't have to worry about it. It is mandated that you have health insurance, but the type of insurance you have is, yours to decide. So, kind of an interesting one in my household. We have stayed on a PPO, a paid plan provider, even though we have access to health savings accounts. And every year we've gotten a piece of information from Blue Cross Blue Shield recommending which policy would be the right one for us. And every year I've stuck with the advice that I don't want a health savings account because, again, it's a high deductible. I think for us it would be $2,500. So we would have to pay that first before tapping into our other insurance. So every year I've opted not to do that, and it's been interesting because every year we would have exceeded that deductible and then some throughout the course of the year. So it's actually been better that we've had a lower deductible, $1,000 I think, but we're paying a higher monthly premium. Again, this is yours to decide, but again, most insurance companies are trying to they'll do an analysis of what you've used in the previous year to help you determine what a better policy might be for you. If you are interested in learning more about health insurance, I'll try to put up a video for you from a different person. You can also go to healthcare.gov law, and you can read the entire 1,200-page Affordable Care Act. Right now, if you are under the age of 26, you can get health insurance through your parents. At age 26, that no longer happens, and you're going to have to get your own insurance. Oftentimes, I've had young people that are even working full-time for a different employer, and they'll ask me, well, should I stay on my parents? It seems to be a little cheaper. Yes, you can stay on your parents. Now, from the standpoint of your parents, here's what I'd tell you. And that's, you're going to be still paying me monthly to stay on my health insurance. So I would want some money coming back from you. But that's not mandated. That's just my rule. Other types of insurance you probably want to consider to make sure that you have and that you are insured in these areas is 1, automobile insurance, good one to have. 2, health insurance. That's mandated. If you don't have health insurance, you'll end up paying a penalty. If you own or rent, you'd probably want homeowners or renters insurance and liability. Now, one of the things you want to consider when you get that is something called an umbrella policy. And this is a liability policy that extends your insurance in the event you get sued, usually up to $1 million or $2 million. Umbrella insurance is extremely cheap. It's like $10 a month, and it will cover you up to like $1 million. Now, there's 2 things you need to know with this. 1, if your insurance premiums are extremely cheap for the insurance you're getting, and you're getting, in this case, $1 million coverage, that tells you the frequency at which you would get sued because of being liable for some reason. And again, if you're paying a cheap monthly premium and you're getting a lot of coverage for that, that tells you how infrequent those things happen. So Something to consider. But again, it's fairly inexpensive, and a lot of people do get umbrella policies. If you're getting life insurance, for most of you, unless you have a small business or family farm, something like that in the situation, then you'll probably want term insurance in most situations. You may want to look for you and your spouse, if one exists, at getting long-term disability insurance. Again, I think of that as AFLAC. And lastly, this is not insurance, but make sure you have a significant emergency fund, especially for these deductibles. Okay, I'll just tell you right off the bat, my automobile insurance deductible is $1,000, health insurance deductible is $1,000, homeowners insurance is $1,000. Don't need to worry about life insurance. That's $3,000 I need to have in an emergency fund, absolutely minimum, in order to pay these deductibles. Your other option is using a credit card to pay for something like that, which I would definitely not recommend when we follow our rule of good debt and bad debt. So things to consider. Again, these are all types of insurance except for the last one that most people have and is recommended that you have and check into. If you have any questions, make sure you email me or contact me through the D2L portal with any insurance questions, and I'm more than happy to try to answer them. Oddly enough, I am licensed to sell property and casualty insurance, not life and health insurance, but for property and casualty. So if you have any questions regarding that, I'd be more than happy to answer them. Thank you, and we'll see you in the next video.